Jim, on StockPicker, I've been noticing a lot of people now asking you about, they want to buy options, they want to buy calls on EMC.
Right.
Now, a couple things that are interesting about this. One is 2 months ago, everyone was hating you, and a little bit me, for saying buy EMC as a VMware
And remember, the 4/18 is the way I would look at it, although one said that, that's the percentage move that we've caught. That's a gigantic move.
It's gigantic, and there's still room to go. I mean, VMware was going to go public at 29, it's over 100.
As we go, I've been always saying it was a Cypress Semi move because of their solar business. Boy, if Applied Materials ever ramped up its solar business, we'd have the same thing. It happens over time. I happen to have a great, I happen to attend a class, and this part I don't want to violate off the record, but with Jim Chanos, talking about 3Com and Palm, and how people were shorting Palm from the beginning and owning 3Com because of the same ratio of stock. And it was a sucker's trade because retail gets very involved with VMware or Palm, and then it destroys the trade momentarily. It delays it. If VMware stays up here, you're going to have another 10 points in EMC.
But what I want to get to, though, is everyone's asking you if they should buy calls on EMC.
Right.
And I have a problem with this in a couple ways, just from my own investment experience. Why not just buy the stock? When you buy the calls on a low volatility company like EMC or a low volatility stock, you're going to be paying a premium that you're never going to earn back.
Right, and that was the focus yesterday, and I'm sorry if I got snippy in StockPicker, but people want to own calls on the wrong stocks. You own calls on a Google and you buy a particular contract that's in the money, maybe you sell out of the monies, but EMC is a slow boat to 30.
Well, and let me try to you're saying something at a gut level from your 20 years of trading these things, and let me try to translate it for the investors. Basically, an option is priced based on a premium, and you're making the bet that that premium is mispriced. The stock is either more volatile than people expected or less volatile if you're selling the options. And I think people think, the guys who are really pricing the options on EMC, the experts, they know what the volatility is. That's a pretty baked-in volatility.
That's the perfect market. That's the line. You can never, let's just analogize to sports. Let's say here, you got the post, all right? So let's just go right to the line. And you'll see exactly what I mean. Sometimes they bury the line, which is too big. What's that about Leno? Trouble with Jay? Come on. All right, here we go. All right, so you get this line of the situation, Cowboys, okay? The opening line is 10, and it's 9.5 over the Vikings. By the way, I like the Vikings because of Adrian Peterson. That line is perfect. That's what...
Right, that's the expert line. You're not going to beat that in general.
Right, you're not going to say, boy, is that line wrong? It should be 7. They have all the perfect information. Now, it's entirely possible, because it's an oblong ball and strange things happen, that the Vikings win by 12. But it's not the percentage play. Right. Don't mess with the line. The line is really smart.
But then I would argue there's a lot of really smart PhD level guys making the line, so to speak, in options. So it's very hard, unless it's the most volatile stocks like Google, Baidu, the Chinese stocks. I would say almost never play options, just buy the stocks.
Right, I would.
Don't use leverage too.
Okay, and what I have been saying over and over again is you use options as stock replacement. The contract that you would buy in EMC without having machines in front of me would be the January 17.5.
Okay,
that
something
way,
in the money.
Right, the in the monies are always a little bit mispriced, and the reason they're not really mispriced, they don't have a lot of pump.
They're not as mispriced though as out of the money because there's a stock price there.
I would actually be going exactly the opposite of what I'm seeing on StockPicker. I would buy the January or maybe even the March 17.5, and I would just continue to sell the in the money. Not the out of the money. I like out of the money. I would sell the 22.5s this month. If the stock went to 25, I'd sell the 25s.
Why not sell the 25s as like a hedge? So to start to pay for your.
Well, it would be fine. Just the 22.5s are so pumped by people who don't know what they're doing. Okay. That's the misprice.
So now you're saying it's mispriced. The premium's mispriced.
The directly just a little bit ins and the outs are mispriced. They're mispriced because of enthusiasm. And they will get more priced well over time. Look, the line is right, but there is retail, and retail can always be bet against.
Well, let me ask you this. Is there an opportunity for a systematic play? So on any stock that is surprisingly 30% down in a day, let's say a biotech stock or a China stock or whatever, buy those calls, and for any 52-week highs...
The most recent one that I saw was Harman Kardon.
Okay.
When that deal broke down, that stock had a lot of ARBs who had to sell because their charter's basically not doing it. So that stock got compressed from 120 down to 80. That was a great opportunity to buy the 75 calls, and the 80 calls were really pumped. But the 75 calls, you've caught a triple win. That's what calls are for.
So you'd still do
other
the in
than
the money
stock replacement. Yes, I'm always an in-the-money guy because the in-the-money guys are not affected by retail, and I like stock replacement. Now, what I would do in a Harman Kardon is that I would buy the in-the-money 75s. They're up there at $6.50. And then as the stock goes up, I would sell common against it, just in case the quarter's bad, but I would do it on a scale. Now, these are all technical terms. The scale means you do it as it goes up. Selling common stock against the option provides for any downside. If the stock went to 78, you pick up 8 points on the downside common as it goes up, and you still have the call, which would be worth something to sell the call, get a little pump. So, particularly if you did the 80s as the thing went up, sometimes I roll up the calls. This is all complicated stuff. Now, a lot of people in Stock Picker want the complicated stuff, but this is a very small universe. I know this because I used to teach options at Goldman. And the one thing is very clear is that the number of people who want this information is tiny versus the people who want to know where EMC is going, which is broad, and where the market's going, which is broader yet.
Well, and so just to summarize, and also I invite anybody who has questions about this to send me an email, post on StockPicker or whatever, and we'll cover it again. I think this was useful. To summarize, though, it's a stock replacement, not a leverage replacement, and look for where the premium is being mispriced.
Perfect.
So great. Thanks very much.